Okay. Um, this is this is about a theory I just recently come up with about peak oil. Um, Now there's a lot of people out there that are familiar with peak oil, and the chart that we're probably all familiar with looks something like this. Basically, what this chart represents is the distribution of oil over time. And if you look here to this side, excuse me, to this side over here, you will see the beginning of oil production at this very low point here. And then as you get up through the 20s, 30s, 40s, 50s, and 60s, um, oil production and consumption go up and up. And when you get up here to the peak, you hit the halfway point, according to the peak oil theory, which actually is really more than just a theory. It's all based upon the idea that you have a finite set of resources, and that you're going to use them over a period of time. And at some point, you're going to use up um, half of that finite resource. Now that dot that you see up there, that is what a lot of people are now referring to as the post peak oil um, place, if you were, the place where we're at currently, which is just a little post peak oil. Now, according to this theory, the distribution of oil ends up looking like a bell. If you look at this, it looks a bit like a bell. It's called a bell curve. And according to that theory, as time goes on, we'll have less and less oil, and we'll conserve, and we'll do all we can to stretch out the supply. And of course, as we come down this side of the curve, the price of oil products goes up and so on. Now, I have a theory I just came up with, and you know, I don't mean to suggest that this theory is a definite. In fact, it's entirely possible that this bell curve is what we're really looking at, and I don't mean to suggest that otherwise. What I am suggesting, though, is there's a possibility of another curve, and this curve is based upon what I call the drunks at a keg. And basically, the way this theory goes, if you had a keg, if there was a party and you had a keg, um, and let's say uh, people are arriving at the party, and as the night goes on, more and more people show up at the party. And this is going to continue in that way. More people are going to show up to the party because there's just more people. You know, the third world country and stuff. People are coming to your keg party. Okay, so anyway, at some point during the night, somebody notices that the keg's half empty. Okay, now how do the keg drinkers react to this? How would they react? Would they start to only fill their cups half full and drink more slowly, or take other measures to conserve on the amount of beer being drank? Or do they continue to drink at the same pace they have been, even as more people come along and drink up the beer in the keg, until at some point the keg goes empty? And this chart would represent basically how such a situation would look on a bell curve, if you will. Only this, in this case, the bell curve takes a sudden drop. It actually continues to increase, and then takes this sudden drop when all of a sudden the keg is empty. Now, a lot of people argue, well, this cannot be because as the price of if the drinkers are representative consumers, then this cannot be because as the price goes up, the consumption of oil will go down, and therefore we would conserve our finite resource, and it would take the shape of the bell curve. But what if the drinkers were the oil producers? As the price goes up, if we think of them as the oil producers, as the price goes up, more and more people come to produce the oil. So even though there's a greater demand for the oil, as more and more countries around the world come to need oil-based products, and so the price goes up. So even though people are consuming more efficiently on an individual basis, the oil producers are producing more and more oil, and that oil is getting put onto the market. And what's the interest of the oil producers? Well, they want their money, and they want it now. They don't care that, maybe if they held out 10 or 20 more years, they would get more for their oil. Okay? Instead, they want their money now. And so that's what this theory revolves around. And it is kind of a scary concept. Short term, it looks good. More oil on the market, more gasoline for consumers, and the prices are probably fairly stable, although high, like they are right now. They kind of stabilize. We produce more oil, and then not as far down the road, we hit this huge drop, this critical point when oil just vanishes. The keg becomes empty, if you will. So that's the theory. I kind of, I'm not going to hold myself too close to this theory because I understand there are some economic arguments that might put my theory in doubt. But that's okay. I'm willing to listen to your theories, and that's really why I posted this video, is to kind of get your theory. Which one of these charts? Which one? The drunken keg theory? Excuse me, drunk at a keg theory, or the traditional bell curve theory? I'm interested in your comments and what you think about it. Your viewpoints are important to me, and I'm not going to hold it against you if you disagree with me. That's fine. I just wanted to open up the discussion on this matter. Thank you very much.